Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. Let's check what happened on markets overnight. The gauge of global stocks ending lower after US President-elect Donald Trump pledged to impose tariffs on all imports from Canada and Mexico, as well as lifting duty on Chinese goods. Stocks on Wall Street, they rose as tech stocks rebounded, while investors also considered the latest minutes from the Federal Reserve, and in fact the Dow and the S&P hitting new record highs. So Donald Trump's tariff threat has hit the large car makers Ford and General Motors, which have integrated supply chains across Mexico, the US and Canada. Wells Fargo, meanwhile, gained on reports that the bank is in the last stages of a process to pass regulatory tests to lift a $1.95 trillion asset cap next year after fixing problems from its scandal over fake accounts. Amgen fell heavily after its experimental obesity drug fell short of expectations, while shares of Eli Lilly rose on forecasts that President Joe Biden will expand Medicare coverage for anti-obesity drugs. Retailer Best Buy fell after trimming its annual profit and sales forecast, and shares of copper miners, including US-listed shares of BHP and Rio, fell, tracking the price of the metal lower as it fell on news of Trump's tariff threat. Well, Federal Reserve officials appear divided at their policy meeting earlier this month over how much further they may need to cut interest rates. That's according to the minutes of the meeting. Participants noted that complications of making policy right now, stating that if inflation remained too high, the committee could pause its easing of the policy rate and hold it at a restrictive level, while others said that rate cuts could be accelerated if the labour market turned down or economic activity faltered. Well, US Treasury long-term yields have risen as a sharp bond rally triggered by Trump's pick of hedge fund manager Scott Bessent as US Treasury Secretary lost momentum. 10-year yields at 4.3% and the 2-year around 4.25%. And Donald Trump's threat to impose tariffs on products from Canada, Mexico and China sent their respective currencies lower against the US dollar on renewed fears of a global trade war. The dollar jumped more than 2.5% against the peso and hit a 4.5-year high against its Canadian counterpart. The Aussie, meanwhile, has also been a casualty. It's currently sitting at 64.7 US cents. And Bitcoin has continued to fall, currently trading around 92,000 US dollars. In terms of commodities, oil prices have eased further after Israel agreed to a ceasefire deal with Lebanon, reducing oil's risk premium. Brent crude down to $72 a barrel, copper falling more than 1%, while iron ore a little changed at $102 US a tonne. And the gold price has edged higher as traders consider the ceasefire between Israel and Hezbollah, while also weighing up the conflict in Ukraine, along with the outlook for global trade under a Trump presidency. Spot gold around $2,630 an ounce. All right, so let's examine the global investment landscape. Elfreda Jonker joining us from Alphinity Investment Management. Elfreda, good to see you.
Good morning, Andrew. Nice to be here.
Can we first start with what we heard from Donald Trump? And yes. I guess it's a question of what do you believe? What is a threat? What is pure rhetoric coming from him? Nonetheless, we saw the market reaction there. What do we need to consider, do you think?
I think we need to look back to 2016 and understand the sort of tactics that he used during his first presidency. He loves to throw something out there as a starting point for negotiations. And then, of course, I think he also secretly probably enjoys the fact that he's got so much control over the market. I don't think this particular tariffs should be a surprise for the market. I mean, he has been talking about increasing tariffs quite a bit in his campaign. The extent of increases on Mexico and Canada, as well as China in particular, I think is probably a bit more than what the market expected for the first two countries, but it's less than that 60% he was sort of notioning for China. But if you think about just the impact on what this could mean for the US, those three countries contribute 42% of all US exports. And then in return for Mexico, 83% of their goods go to the US, and for Canada, 75%. So the impact could be a lot bigger for those countries, and that's why, as you've just mentioned, you've seen those currencies fall. The big impact going forward, if this were to come to pass, and I think there will be a lot of negotiations and different ways of doing it, is really what this means for inflation. Because if all those products are going to increase, the US inflation would definitely increase. And that's, of course, then what this means for the interest rate outlook and for growth. So there's a lot of uncertainty, and I think we just need to sit back and get ready for 4 years of Trump's social media comments and, having to dial back and just digest it over time.
So as we approach the end of the year, does that make it just more difficult to forecast what we're likely to see next year, particularly as far as equities are concerned? Because I see you note that 2 years into an equity bull market, also an earnings upgrade cycle there, although you're saying that perhaps that's weaker than previous cycles.
I think as global equity investors, it is important to just have a look at where you're at in the cycle. So as you've mentioned, 2 years ago when the market started to rally, we're up 40% since then, if you look at the US market. And the earnings cycle, which is really the lens that Alphinity uses to look at stocks, that's up, sort of into an 18-month up cycle. And I think the point that we're making here is that it is actually not an incredibly strong earnings growth cycle. It's actually relatively weak, and it is not necessarily very diverse. So we sit back and we look at the multiples where they're at, and pretty much every single one of the big indices are now trading at or above their long-term average. And definitely markets like the US is trading at the upper end of it. So the dependence on earnings to drive returns from here just becomes a lot bigger. So we won't be surprised if the narrative turns a bit more cautious into next year, when we start to get a better sense of what all these tariffs and things might mean for the economy and for earnings. I think it's going to be a stock picker's market. I guess it always is, but definitely into next year, we think investors need to pay a lot of attention on valuations and how much companies can actually generate in earnings.
So given that, are you taking perhaps a more defensive approach in your portfolio?
Yes, we haven't really increased a huge amount of defensives just yet. I mean, we look at the earnings leaders, or those companies that's got earnings revisions that can surprise relative to market expectations. And so far, if you look at the last earnings season, for example, it's still been tech driving the majority of that earnings growth. So we believe in diversification, particularly in our global funds across regions as well as across sectors. So we continue to have that diversification. Have been adding quite a bit of cyclical exposure over the last, I would say, 6 to 12 months, capital markets opening up, a whole range of non-traditional commodities making its way into the portfolio. We have added some defensive exposure, like Coca-Cola, for example, but you've seen these stocks out of favor at the moment. But it won't be surprising if we look into the next 6 to 12 months that we would have tilted our portfolio quite a bit as a lot of these more cyclical companies start to run out of steam, in combination with some of those large tech and the more expensive growth stocks could potentially run out of a bit of steam at some point.
All right, so how are you treating those, those tech stocks? What exposure do you have there?
So at the moment, we still have quite a bit of exposure to the Mag 7, for example. So we've got Microsoft, which in our view is still one of those that you can hold through the cycle because it touches all the different stages of AI, for example. And in particular, what we're seeing now is this move towards more the software and services that sit on top of the semiconductors and the infrastructure that's already been running, that part of the market, the NVIDIAs and so forth. But we also have exposure to Apple, to Amazon. In particular, Apple is one that we've probably added the latest of our Mag 7 exposure, and we continue to think they can actually grow quite a bit more as you see Apple Intelligence being rolled out. And then we also have a bit of Google. It is probably the one, or Alphabet, it's probably the one that keeps us up the most at night, just given what's been happening from a regulatory point of view.
Well, the risk of
all of that.
It's going to be broken up.
Yeah, the risk of being broken up. So it has been a really good alpha contributor for us, the Mag 7 in total, or the Mag 5 that we've owned. But at this point in time, it has become a capital donor. And we continue to look for other opportunities. And as I've said, that is where we've added some more of the cyclical exposure and probably a little bit more on other growth stories in the market rather than just big tech.
What's your view on consumer-orientated stocks at the moment?
Yeah, so our global team travels a huge amount. So just in September alone, the 6 members of our investment team saw over 200 companies in 6 different countries. And I think the general feedback is that the consumer is actually holding up relatively well, particularly in the US, but it is bifurcated still. Really, it is about the high end doing okay, and some sectors of the economy that's linked to that doing okay, besides luxury, that's more linked to what's happening in China, which is another discussion point. But on the other hand, what we are seeing is consumers, particularly those on the lower end, moving more towards the sort of club models, the Walmarts, the Costcos, where they can buy a membership fee and then get really good quality products at a lower price. So they really are very specific about where they're going and what they want to buy. So in that space, we do have Costco. We continue to hold it, even though it is also one of those stocks that's getting quite expensive. But we have added something like a Chipotle, for example, which is a stock that's actually fallen quite a bit on the back of general concerns about what we've seen in sort of eating out companies like a McDonald's and the CEO leaving. But we really do see that as one of those higher quality companies. They don't necessarily need to trade down to actually get their sales. So we're actually optimistic about that one, for example. So we have exposure, but we still underweight the consumer in general.
And Elfreda, what's your view from you and your team on China? Obviously, with the prospect perhaps that we will see more tariffs on Chinese goods, but how the economy is travelling in those Chinese stocks?
Yes, so one of our portfolio managers in our domestic team has recently been to China for a 2-week trip, really seeing a whole range of sort of industry sectors across the supply chain, trying to get a better understanding of what's happening with commodities and the economy. And I guess his main feedback point is that this is a consumer confidence crisis that's currently playing out in China. If you think about most of them not having the growth in their home prices, they haven't seen growth in the property market, but also in the stock markets. So there really is a focus now for that government. They need to fix that problem. They need to fix the consumer rather than spend more money on infrastructure and build more houses. So we think the recovery out of that will definitely need to do a lot more. So the feedback is pretty dire. Most of the companies that we've seen in Europe as well as the US with exposure to China has definitely been telling us it's bad and probably going to get worse before it gets better. So we do expect to see more sort of announcements from the government in order to see that really accelerate. But clearly Trump is not going to help whatever is going on in China. So we've been, sort of really staying clear of sectors such as the luxury, for example, that's very geared to that Chinese consumer in particular.
Elfreda, thanks so much for joining us from Alphinity Investment Management.
Thank you. Thanks.
Let's take a quick look at where we're likely to get going and looking for a positive start there. SPI futures up almost 0.5%. Stay with us because the open is just a couple of minutes away.